What are the causes of that? You may have cash, A, because you made a lot of money and you kept it. So that's called cash flow from operations. You may have cash because you actually sold your assets. Let's say you had a subsidiary, you sold it, but brought in cash. You may or may not have made money on it, but it brings in cash. Or you have more cash because you borrowed money. So it decomposes into cash from operations, cash from uh, financing, and cash from investing. Okay? But for our class, we're only interested in finding out what is the depreciation number, because that number is not actually in the income statement. And we also want to know how much, if any, company paid in dividends and stuff. All right. I said that there are a structure to these things. Now, let's first write down the mother of all accounting identities. Total assets. I'm going to always abbreviate that as TA. Yes. Oh, I'm sorry. Right before class, I was looking at the breakdown of my parent plus loans for my kids. Because my younger son is a junior at Boston College now. This year, they gave us a financial aid that was $20,000 less than what they gave last year. Yes, one of my sons finished college, so that has an effect. But they're appealing, so I had to tell them that this is how much I owe and this is how much per month I was going to pay. I didn't want you to see it, that's why I turned it off. Total assets are equal to total liabilities, abbreviated to TL, plus total equity. Sometimes we're going to call that owner's equity. Sometimes we're going to call that shareholders' equity. If I don't say anything and just say equity, that means I'm referring to total equity. This is actually where the name balance sheet comes. In the old days, we had the balance sheet in actual ledgers. It had two sides. On the left, you listed the assets. On the right, you listed the liabilities and total equity. And the sum of the two sides has to be equal or has to balance. That's why it's called a balance sheet. If they don't, you owe certain amount, you own certain amount, the difference is your equity by the very definition. We're going to divide the total assets into two. That's CA. The reason we call that net fixed assets, we're going to define what a fixed asset is. Technically, a fixed asset is an asset that is not a current asset, but I haven't defined what a current asset yet. The reason we call it net fixed assets are subject to depreciation, amortization, and that sort of stuff. The way we book them is cost of acquisition minus any accumulated depreciation. I bought a computer. I bought this computer last year, I think for about $1,200. And if this was a corporate asset, it's probably subject to 3 years makers. So I could have written off 1/3 of it as depreciation. So $400 for tax purposes and for otherwise purposes is depreciation. So my net value of this for the books is $800. Now that's a book value, the value you keep in the books. That does not necessarily mean that I can sell this computer for $800. Who knows? Maybe I can sell it more, which I doubt, because these things depreciate quite a bit. Or more than likely, it's going to be less. The value at which you can sell an asset is called market value. But the value you can sell an asset without actually taking a big haircut. I can sell anything quickly. For example, if I had a Boeing 787, how much those things cost? 100 million bucks? I don't know, something like that. I can sell that within probably 10 seconds on Craigslist or eBay. But if I want to sell that in 5 seconds or 5 minutes, I'm going to have to get a big haircut on that. Haircut kind of is a euphemism. It's the difference between the value that you could sell if you are willing to wait versus the value you sell if you're not willing to wait. And haircut on that would be very deep, you know, a French haircut or French Revolution haircuts. But if I'm selling a lemon, it's just a lemon, right? I can sell that very quickly without worrying too much about price impact. Now, the way we list assets on balance sheets, we list them in an order of decreasing liquidity. But I have to define what liquidity is. Liquidity. The speed with which an asset could be converted into cash without much price impact. Given that definition, obviously a Boeing 787 should not be considered a very liquid asset. On the other hand, if you have $10,000 in your bank account, that is a very liquid asset. All you have to do is go to your ATM, get the money, or if you want to pay someone else, just sell the damn money. You know, yesterday my son says, "Oh, Dad, by the way, I realized my bank account is negative. Can you sell me 150?" Sure. It was there within what, 15 seconds. All I have to do is go to the app of my bank, boom, boom, boom. That's it. On the other hand, if you own half of Google is a lot of money. I think it's about these days $900 billion. That's billion with a B, one followed by 9 zeros. Selling half of Google is going to take a while. You could sell it in the market, but it's going to take a while. For example, let's see how much daily transaction there was in Google. Oh, let's look at NVIDIA, since I'm already there. Let's see what's the volume today. Where art thou? Okay, average volume, for example, 348 million shares, assuming a price of $100. That's about $35 billion worth of NVIDIA per day. If I own half of NVIDIA, and that's about $1.3 trillion. Well, it's going to take me a few days to sell that. In fact, if I don't want that to have a price impact, I'm going to have to do that over a longer period of time. So owning 100 shares of NVIDIA is a liquid asset. Owning half of NVIDIA is not. So even within the same asset class, it may not be liquid. If you own a building, that's not a liquid asset. Car, somewhat. These days, I can sell anything on Carvana pretty quickly, but more than likely, I'm probably getting a haircut on that. I could do better bargaining with the dealers. Because Carvana tells you an algorithm. Dealers, they have other things in mind. They want to sell you a new car, but even if they're not making too much money in the new car, They're going to sell you other things. They claim is of very high value, and it's not. When I bought my last car, I have a 2023 Subaru. I traded my other car, and I only paid those days. Slightly used cars had very high value because of COVID issues. I only paid $1,000 out of pocket to get the new car. The car I sold, I had 25,000 miles on it and had an accident on it, despite all of that. And this guy is trying to sell me. He gives me all sorts of warranties and stuff. I said, no, thank you. He almost got mad. He says, do you know how much value you're turning down? I said, man, I am teaching finance for a living. I can actually calculate values of these things. He was still unhappy because he gets a commission out of it. But, they gave me a pretty good price in the hope that, they can take advantage of me in something else. And I wasn't born yesterday. Plus, I come from a culture where bargaining and haggling is part of the culture. If you go to the carpet shop in Istanbul, the Grand Bazaar or the Covered Bazaar, and they know you're Turkish and you don't bargain, they say, you really think that much of me? You don't even bother to bargain with me?